All right, let's jump right into the world of insurance accounting. And yeah, I know, it can sound incredibly complex. For a long time, the main rulebook was something called IFRS 4. But here's the thing. IFRS 4 was never meant to be the final answer. It was always designed as a temporary fix, kind of like a bandage, to solve a really massive problem. And to get why it even existed, you first have to understand the mess it was trying to clean up. So, let's wind the clock back to before 2005. If you picked up the financial reports for two different insurance companies, it was like trying to read two completely different languages. There was just chaos. And it all boils down to this one simple question. Why was it basically impossible to compare them?
At the heart of it all was a simple fact. There was absolutely no global standard. Every country, every region had its own way of doing things. It was this crazy patchwork of local rules, and that meant zero consistency. For anyone trying to look at the insurance industry as a whole, it was a gigantic headache.
And here's why that was such a huge problem in the real world. Imagine you're an investor. How do you possibly decide which company is a good bet? Or if you're an analyst, how can you tell who's actually performing well versus who's just good at hiding risk? The honest answer is you couldn't. It was a classic case of comparing apples and, pineapples. It made judging the true financial health of an insurer incredibly difficult.
And that's exactly where IFRS 4 comes into the picture. It was basically phase one of a much bigger project. It was never meant to be the forever solution. It was just a first step, designed to bring in some badly needed improvements and a little bit of transparency, while the real, long-term fix was being worked on.
So to really get what IFRS 4 is all about, we have to start with the most basic piece of the puzzle. What even is an insurance contract according to this standard? Well, it all comes down to one absolutely critical ingredient: the transfer of significant insurance risk. It's not about what the contract is called or what it looks like. It's about whether the insurer is truly taking on a real risk of loss from the person they're insuring.
And that brings us to a really important distinction in the standard mix. It draws a clear line between insurance risk and financial risk. See, insurance risk is personal. It's specific to you, the policyholder, like the risk of a fire damaging your house. Financial risk, on the other hand, is about big market stuff, like interest rates going up or down. That affects everybody. IFRS 4 is laser-focused only on those contracts that transfer that specific, personal insurance risk.
So what did this temporary fix actually do? Well, it brought in a few limited but really powerful improvements. First, it outlawed a shady practice of setting aside money for made-up future disasters on policies that hadn't even been sold yet. But the real game changer was the introduction of something called the liability adequacy test. This forced insurers to constantly check if the money they had on hand was actually enough to cover future claims based on today's best estimates. For an investor, this was huge. It was a new way to peek behind the curtain and ask, can this company really pay what it owes down the line?
But of course, in accounting, nothing is ever simple. Just when the industry was getting the hang of IFRS 4, a whole new challenge popped up on the horizon. And this time, it had nothing to do with the liabilities, the promises to policyholders. Nope, this was all about the other side of the balance sheet, the assets. A massive new standard, IFRS 9, was on its way.
And here was the problem in a nutshell. The timing was all wrong. IFRS 9, this big new rulebook for assets, was ready to go live years before its partner for insurance liabilities, the eventual IFRS 17, was even close to being finished. This mismatch in timing created a massive industry-wide headache.
Think about it like this. It's like you're trying to build a house, but you're measuring one wall in inches and the other wall in centimeters. The numbers just aren't going to line up, right? It's going to look all wrong. That's exactly the problem insurers were facing. They were being forced to measure their assets and their liabilities using two completely different accounting models.
And this mismatch had some really wild effects. On one side, you have IFRS 9, which says most assets have to be measured at their current market price. That means their value bounces up and down every single day with the market. But on the other side, you still have IFRS 4 for the liabilities, which often used older, much more stable methods that didn't change much. So what happens when you put them together? You get these crazy artificial swings in profit that have absolutely nothing to do with how the company is actually performing. It was just accounting noise.
So to deal with this mess, the rulemakers had to do something, and fast. They decided to amend IFRS 4 by essentially slapping on a couple of big workarounds, patches really, designed to help insurers manage all that fake volatility until the final permanent fix was ready.
The first solution was, beautifully simple. Just let certain insurance companies hit the pause button.
is called the temporary exemption, and it basically allowed them to just wait. They could stick with the old accounting rules for their assets and not adopt IFRS 9 until the new rules for their liabilities were finally in place.
But not just anyone could hit pause. You had to prove that your business was, as the standard put it, predominantly connected with insurance. And it all came down to a numbers game. Either more than 90% of your total liabilities had to come from insurance contracts, or if you were in that 80 to 90% range, you had to show that you didn't have any other major side businesses, like a big banking operation. So what about everyone else? What about the insurers who couldn't get that exemption, or maybe just chose to go ahead and adopt IFRS 9 anyway? Well, for them, there was a second option, a pretty clever trick called the overlay approach. This was a way to follow the new rules for assets while filtering out all that artificial accounting noise. Now, here's the crucial part. The overlay approach didn't make the volatility magically disappear. Instead, it let an insurer take those artificial profit swings caused by the mismatch and move them. They could take them right out of their main income statement and park them in a separate bucket called Other Comprehensive Income. This gave investors a much clearer view of the company's real, underlying performance without all the noise. You know, when you look back at IFRS 4, all these technical rules, the workarounds, they aren't the biggest part of the story. The real, permanent, and I'd say revolutionary legacy of IFRS 4 was something else entirely: disclosure. It was all about transparency.
And you can see this baked into the standard right from the very beginning. This quote, pulled directly from its main objective, says it all. The goal was to provide disclosure that helps people, well, understand the amount, timing, and uncertainty of future cash flows. In other words, it was all about helping people see what was really going on inside these complex companies.
And that right there is the key takeaway. The specific accounting rules in IFRS 4, they were just a bridge to get to something better. But that demand for radical transparency, that wasn't temporary at all. That was a permanent revolution that fundamentally changed what the market expected from the entire insurance industry forever.
And what did that transparency actually look like? Well, suddenly insurers had to open up the books in a whole new way. They had to reveal their secret sauce, the key assumptions they were making. They had to show how sensitive their profits were if those assumptions changed, where their biggest risks were concentrated, like for hurricanes in one specific area, and maybe most importantly, how their actual claims were stacking up against what they had predicted in the past. It was a flood of incredibly valuable new information for investors. So in the end, IFRS 4 did its job. It was the patch. It was the temporary fix that held the accounting world together and kicked off a whole new era of transparency. It successfully paved the way for a true, permanent global standard, which, of course, leaves us with one last really big question. What did that permanent fix actually look like?